is a lot of property management company don't really manage money very well. They move around funds across different ownership, different properties as well. And that's a big problem, right?
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, we've got the North Star Real Estate Conference coming April 24th and 25th in Minneapolis, and this conference is going to be for everyone. We're covering the gamut of real estate. If you are just beginning, this conference is for you. If you have 100, 200, 500 units, this conference is for you. If you want to get into commercial real estate, this conference is for you. And the best part about the North Star Real Estate Conference is the networking. The networking is phenomenal. We've got high performers there. We've got amazing speakers and amazing attendees that are going to be adding a ton of value to your business. We can't wait to see you there April 24th and 25th. Check it out. I'll see you there. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me today, I'm excited to have James Kandasamy. James, how are you doing today?
I'm doing awesome. Thanks for having me on your show. Happy to be here.
Definitely. I appreciate you joining me. And why don't you give our listeners a little bit about your background, how you got into real estate, and where are you at today?
Well, my background is started working as an engineer, worked for 22 years in the corporate world. I think, and after that, I was doing my single family houses in 2013 for 2 years. We did like 13 single family homes. We pulled out a lot of their equity, even though we still have some of the houses there. Pulled out a lot of their equity and moved it to multifamily. Right now, we own almost 1,700 units. Of course, with our passive investors, but we are the only GP in the deals. We have raised almost $35 million across 228 investors, and portfolio size is 130 million, but that's portfolio size. So, but we own the entire operation A to Z, which is asset management, acquisition, financing, and we also do property management, and also we do construction management. So we own the entire pipeline.
So you kind of vertically integrated. So I'm assuming with that, you're doing it in your own backyard?
Yeah. It's best to do your own backyard in that case, because the local market, you can be, you can have more economy of scale.
Well, take me through well, first of all, I want to say something. And you said you've got, what did you say, 1,700 units?
1,700 units, yes.
1,700 units.
Yes.
And one thing that you said that I want to hit on, and it always strikes a little bit of nerve with me when people say, oh, we got 1,700 units or 2,000 units or whatever. And you find out that, well, they are like 0.5%.
0.5%.
But you said something, said you were the GP, the sole GP, or your company's the sole GP in every single one of them.
Yeah.
And for our listeners who maybe don't understand that whole, that means that you're actually, I mean, not majority, because your investors are probably the majority, but that means you've got the ownership of those. I would call that, hey, you actually own the 1,700 units.
Yes. We are the one neck to choke shop. There is no other GPs. We raise all our money ourselves. We operate it ourselves. I communicate direct to my investors, and we have employees working for us. We have almost like 45 employees right now working for us. We build up that company from ground up on our own with our passive investors.
And so all your properties are based in
San Antonio and Austin.
Antonio and Austin. Okay, great. So how did you go from you were doing some single families? How did you go from that and decide, hey, let's just start buying these big properties with a bunch of partners?
Well, I mean, we love single family. It's easier to find deals in single family. It cash flows much higher if you have one by one, right? But when you're really good at doing single family, you want to do a lot of it, and you get stuck at after 10, 12 properties. I mean, financing, the amount of work, and the amount of insurance renewal that you have to do, all kind of things, because everything is single individual entity, right? It becomes a lot of work, and it doesn't scale. So we decided to move out to multifamily, and I was having a lot of hard time between single family moving to multifamily, because in multifamily you really don't get a lot of cash and cash return in the beginning, right? But I found this forced appreciation concept, which a lot of people are missing out when we talk about multifamily, right? Multifamily, it goes based on NOI, and you can use your skills to force appreciate the value
Yeah.
compared to single family, and that makes a lot of difference, when you come to returns and the scale and how you can utilize this large sum of money to make a lot more money compared to small money. You have to do a lot of work to grow the returns compared to this large sum of money where you can grow much more efficiently, I would say.
Yeah. Yeah. And so did you go right from the single family space to like 100+ unit building, or did you take steps to get there?
Oh, we bought our first deal was 45 units, right?
Okay.
So
Did you
um,
syndicate that deal as well?
yeah, it was syndicated. We had like five
Okay.
investors with that. And after that, from 45 units we went to 174 units, and both deals were found off market. We did direct connecting directly to the sellers, so we got really good deals, great deals on it. And after that we went 115, and the last deal we did, we have like 9 properties now. The last deal we did is almost 346 units.
Is that your biggest deal so far?
That's the biggest deals, yes. 346 units, yeah.
It's a good sized deal.
Yeah. You can always buy bigger deals, but the numbers need to make sense, right?
Yeah.
So
Yeah. How did you find that deal? Was that through broker relationship? Was that through off
um,
market? What was that deal?
the last one,
Yeah.
the last deal was directly from seller. So as the market is so hot right now, I'm not even looking at deals that is coming through emails, marketed, and all that, because I'm not really a fan of best and final, bidding against
Yeah.
yourself. I think and you'll be ending up, paying the highest price, at the hottest market. So you're getting double, triple whammy, right? First of all, the broker would have promised the seller high price to get
Yeah.
his listing, right? I mean, the
Yeah.
seller had an option to go to many brokers, and he select one broker which has given him probably the highest price. So first, the broker already promised. Second is they come and market it, and they do best and final, right? And best and final, right? So many self bidding happening, and after that, the market itself, we had one of the longest expansion cycles. So you have like 3 different factors that have cost you to pay. Really, you have to overprice for to get that deal, right? So I do not want to pray to make money on my investment. I rather use my time to find deals which is come through different channels. Like the last deal we did, we bought directly from the seller. It's almost a $30+ million deal.
So are you willing to share with me the secret
Mm-hmm.
of how you found an off market direct to seller,
Mm-hmm.
300+ unit building? How do you find something like that? Is it the same as finding a single family, or what do you do?
Well, let me tell you the secret for my first 2 deals, and I come to the last one because it's 3 different approaches, right? So the first 2 deals we found, we saw 45 units and 174 units. We found using cold texting, right? So I
Cold
did,
texting.
yes.
Really? Okay.
It's not even cold calling or cold emailing. Even though I tried cold calling, I tried yellow letter marketing too, right? So we tried a few options, right? I mean,
Yeah.
my concept is you have to do what 99% of the people do not want to do, right?
Right.
So to find deals, right, to get started. I mean, we bought that deal in 2015, and even I can tell you in 2015 the market was really really hot as now, right? Um, so it's always harder to find deals. So when we found that deal, we used cold texting, and we found the guy who's connected to the seller, and they sold us the first 2 deals, right? But the last deal, the one I got, the $330 million deal, is I got it through my Facebook group. It's called Multifamily Investors Group in Facebook. And we have our own group. We have like 4,000 members in it, and just putting yourself out there as an expert. And I said,
What did you say? I'm looking for a 300+ unit building. Please send me your deal.
no.
Oh, cool.
I didn't even approach them. They texted me. They say, hey, there's a deal in this city. They know I'm a buyer in that city. So
Yeah.
And he just texted two liners. We have a deal, 50% rehab. Are you interested or not? I get a lot of that kind of texts all the time, right? Or email, right? And I know a
Yeah.
lot of wholesalers are trying to sell. And I say, sure, whatever it is, send me. And he really sent me a P&L. And I was, okay, let me see whether this guy is a true guy or not.
Huh.
And to my surprise, he's a really an acquisition guy on a big firm out of Denver. And I mean, they did try to sell it, but selling it through other channels have different fees, and since they know that I'm a true buyer in that market, they just offered it to me. And yeah, it was a fun ride to buy that deal because working directly to the seller. And everybody was professional, right? So we negotiated the price, we did the due diligence. At some point, I did try to come out of the contract because the price didn't match what we found in due diligence. But later they came back to me and gave me what I wanted. So, I mean, the price made sense at the end of the day compared to the rehab that we need to do. And,
Yeah.
they win and we win too, right? So
Yeah.
it's
And
crazy.
that's what matters. I mean, it's got to, the numbers have to work out for you. It doesn't matter if the broker brings it to you or you find it
Yeah.
off market. Have you bought deals from brokers? Have they all been completely off market?
No, no, no. I bought it from brokers, but I don't think so. Any of my deals are through. Maybe one, maybe through a
Fully
I don't think so.
marketed
I don't think so.
access.
It went through a best and final. It just that
Yeah.
was marketed. There's few guys, and broker said, "Hey, you're the best guy. You're the most qualified guy."
Yeah.
And I think maybe 1 out of 9, right? If I'm not mistaken.
Every deal by a broker, by the way, is on market. We just say it's off market, but it's
Yeah.
been listed. Maybe not listed. It's maybe not
Hmm.
fully shot out there, fully packaged, but the brokers at least talk to more than just you. You'd like to think
Correct.
you're the
Absolutely.
only one, and sometimes I go and think I'm probably the only one. But really, probably not. Probably
No, no,
not.
there's no such thing as off market. There is such thing as off market premium, right? When they tell you this is off market, you may have to sometimes, a lot of times, buyers do pay a lot more than putting on market because they think there's some cool
Yeah,
factor to it. Compared to you going back to the seller and say that I already marketed this to death and this is the price you can get. The
this is the
seller are more,
price.
this the seller is more receptive to that. I mean,
Yeah.
compared to, we tried off market and we got this price, and the seller may think, oh, maybe I can get more if I market it, right? So,
Right.
but it's a psychological effect on the buyer side and on the seller side, right? Buyer thing is I'm getting a great deal because it's off market. On the seller side, they just want to get rid of it, or they know the broker does it their best to find the best buyer.
So tell me a little bit about the vertical integration,
Mhm.
and why you decided to go that route versus just being a multifamily acquisition company and then hiring everything else out.
So when we started on our 45 units, we did contemplate to use third-party property management because that 45 units was managed by third party. But when we look at the P&L, we see so much of inefficiency, right, on the third-party property management company that was managing that property. And this is one of the largest property management company in like in San Antonio, right? And we were surprised if these people are doing this inefficient,
Yeah.
and most of them are going to be like that. And even this, every deal, every first two, three deals, we always say maybe we should give third party. But every time we look at these different property management company who are like the largest companies in Texas, so much of inefficiencies, right? So and
What's one inefficiency that you can point at?
well, very simple, right? Like for marketing, right? So any random property management company is going to randomly invest money into like 3 or 4 marketing outlets, right?
Yeah.
Apartments.com, apartment lease, and I mean for them it's just money to be paid for marketing. It's just a budget, right?
Yeah.
But as for me, I would always look what is the most effective
What's my
advertising.
ROI?
Yeah,
Yeah.
what's my ROI, right? It's 80-20% rule, right?
Right.
So if one ad source is giving me a lot more leads than the others, why should I pay the same amount of money, right? So I
Yeah.
just cut it off, right? So I usually do that kind of experiment. So we always look for the best marketing source and stick to them. So that reduces your marketing costs. Even payroll, right? So on a 300 units is by default you need to have 6 employees, right?
Yep.
But we have seen when properties are stabilized, you probably need like 5 employees, right? Because there's not much things to do when things are stabilized, when your operation runs very effectively. But if it's third party, they're going to say, no, 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 we need six. Don't
Six.
negotiate with us, right?
Yep.
Because they do not want to they do not want to take that chance of reducing their staff and all that, right? So,
Yep.
but if you are own operators, you can always look on what are they doing every day. Are they being really busy? Can this one person do 2% job or not, right? Is the office really busy, right? So you can look at all these, which reduces your expenses and
And you
increases your
never ask
NOI.
the office staff, by the way, if they're busy, because they're always going to say yes.
Yeah, they're always busy. But we can see, I mean, when we go
Yeah.
to the office, we can see how busy they are, how much phone is ringing. Usually when the phone rings a lot, there's a lot of work orders are not being done. So it's not because the people are busy for no reason, right? So
Yep.
maybe your maintenance crews are not good. So we look for that kind of things, and we try to diagnose and try to reduce expenses as well. I mean, there are cons to being an owner operator as well. Like there's a lot of process and system that we have to create ourselves compared to
Yeah.
the third party where they already established. They have a lot of staff, they can move around. Whereas we have to like really suffer with our own, like, one or two property managers that we have when we are starting up, right? Once you grow
Yeah.
bigger, you should be fine. Accounting team need to be well funded and need to be smooth, need to be done correctly. So we have to learn through the hard way to do that right. Now we got it right, but in the beginning we it did take some time, some process to do that. So there are pro and con in both, but I think our primary reason is a value. We do a lot of value add, and we need control on the deals to turn around quickly. And if I give it to third party property management, first they're going to take really long time to turn because it's not their baby, right? It's not their investors they need to answer. Second is they're going to charge me general contractor fee, project management fee, all kind of fee they're going to charge because it's additional work for them.
Yep.
And in essence, you don't really make money in property management. It's more of a control to get to the end goal of investment business plan.
So are you charging your investors a property management fee, or are you just charging them straight cost?
Oh, property management fee.
Yeah. Yeah.
That's that's
You're
that's
running
uh
just
that's
just like you are using a third party. You're charging
yes,
yourself essentially a third party fee, or charging
correct.
your investors.
Yes.
Yeah.
That's part of the operation, right? I mean, any lenders, any buyer, is expected to have a,
Yeah.
you know, uh, three plus percent of management fee.
Yeah. And then you said you do construction in-house too?
Yeah, I mean, construction is not like we do ground up construction.
Yeah.
We manage our own rehabs. We don't hire
Okay.
GCs. So it's just we found out the GCs to be expensive, right? And
Yeah.
GCs are good. They're not really good with managing their funds. End up they take up like 2 3 projects all around the city, and they delay your projects. The fund is not there and all. Okay, so we said forget about all that. Now we're just going to do it ourselves, and we just hire our subcontractors. It gives us a lot of leverage in terms of building relationship with subcontractors.
Yeah. 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 I mean, I used to do a lot of flipping every
Hmm.
single year. It just didn't make any sense to hire
Hmm.
general contractors when they might be charging you 15%, but in reality, it's probably more like 20 to 25%.
Yeah,
When you look at
correct.
the overhead, and
Yeah,
you look at the material overruns that they have and all that kind of stuff. So, and then
yeah,
they, like you said, you can't control. Most of them aren't very good at business management or money management, in my opinion.
correct. Yes.
And if they are, they're probably charging you even more.
No,
Uh,
if they are, they're probably doing much more higher, sophisticated level of general
yeah,
construction, right? If they're
yeah,
doing single family or small multifamily, they're probably not that sophisticated, right?
yeah,
So
yeah.
that's why they are doing at that level, right? So
Right, right. So it
because
makes a lot of sense.
GC's skills are very important. It's very hard skill to find, but it's just so hard to find a GC who's like, you know, charging you reasonably at the same time, being on schedule, manage your money and all that. They always roll around money. And similar to property management companies, a lot of property management companies don't really manage money very well. They move around funds across different ownership, different properties as well, and that's a big problem, right?
Yeah,
So
yeah, yeah. You definitely want to be aware of that, where these funds are going, and I've seen statements where it's like, well, who's this person? Like, oh yeah,
mm.
well we paid this bill through your account because of this. It's like, wait a second, that's not how it works. I'm
Yeah,
not
yeah,
your bank.
yeah.
So
Yeah, I didn't know that thing until like when I hire, a few more senior level people in property management, and we were telling them, all properties is self-funded, right? They were surprised. Wow, really? I mean, you don't move around money? No.
No.
And I asked them, is it common practice? They say, yeah, it's very common practice to move around money between ownership and properties, right? So,
Rob Peter to pay Paul.
yeah. So I don't know whether everybody's doing it or not, but certainly there's a quite number of property management company doing it.
Yeah, I mean, I can see it happening on a definitely, but it's
Mhm.
something, in my opinion, it should be avoided if you can. I mean, you're
Oh yeah, you shouldn't do that. I mean, you can
yeah,
commingle different investment money for different.
right, especially when it's not. I mean, whether you're dealing with investors or however, it's those are different
Mhm.
money allocated for different reasons, and you're trying to play the banker. Just
Yeah,
you're going to end
yeah,
up getting yourself stuck in the end.
yeah. I mean, everything is good when market is good, like right now. But when
Right,
market turns, then
market
then a lot
turns.
of
Yeah.
things will be.
Hey, we've got the North Star Real Estate Conference coming April 24th and 25th in Minneapolis. And this conference is going to be for everyone. We're covering the gamut of real estate. If you are just beginning, this conference is for you. If you have 100, 200, 500 units, this conference is for you. If you want to get into commercial real estate, this conference is for you. And the best part about the North Star Real Estate Conference is the networking. The networking is phenomenal. We've got high performers there. We've got amazing speakers and amazing attendees that are going to be adding a ton of value to your business. We can't wait to see you there April 24th and 25th. Check it out. I'll see you there. What do you think about that? What do you think about market turn? Where are we at? No, I don't want to ask you where we're at because that's an
Mhm.
unfair question because
That's an
nobody.
economics question.
Right. But where are you at as far as like your philosophies moving forward? Are you aggressively buying? Are you really pulled back and maybe not buying? Kind of where are you at in that whole assessment of things right now?
So I'm not aggressively buying. In fact, I've stopped looking at deals, cookie cutter deals, right? Cookie cutter value add deals, right? Like 15, 20% IRR, I'm no more looking at that kind of deal. So
Interesting.
I'm completely changing my strategy, not to be aggressively buying, but, try to look for off market deals where they are distressed debt or distressed owners. I rather wait for that kind of opportunity to come rather than keep on buying deals. So my goal is not to buy like 5,000 units in the next 1 year or 2 years, like some people are 2,000. So I'm no more putting a goal based on units because I think that forces you to buy, bad
Yeah.
deals.
Yeah. Yeah.
Right.
For
So,
sure.
so I'm just taking it slowly right now. Multifamily is not the only asset class which makes money, right? There's also other asset classes which
Mm-hmm.
makes money. So
Mm-hmm.
I'm evaluating that as well, even though I'm very, very particular about sponsor focusing on maximum 2 asset class, right? Because there's a lot of nuances in each asset class. So I'm still evaluating that. At the same time, I'm focusing a lot on operations, putting in systems and process to make sure that my current deals are doing well, right? Because that's very important when market turns.
Yeah. Yeah. So when you're talking about, more distressed properties, are we talking about properties that are low occupancy, 70% occupied, maybe 60% occupied? Are we talking
Mhm.
about properties that just have um, kind of kind of major renovations? Is that the type of properties you're kind of hunting
That
for
is
right
one
now?
of it. Yes, that's one of it. But you need to be priced to that whatever
Yeah.
value that I can bring. I mean, you can't say 70% occupied, but I'm going to sell it as though it's 80% occupied, right? So
Yeah. Yeah.
there's a lot of deals like that, right? So I mean, because the market is so strong, a lot of people are looking at multifamily now. That kind of deals are potential to happen, right? So I'm looking more for true deals, right? So distress deals, distress operators, and potentially distressed debt as well. So a lot of these are not available right now,
Yeah.
right?
Yeah.
So, but I'm trying to see how can I be prepared for it,
Yeah.
right? So,
It's funny that you say that because I'm kind of doing essentially the exact same thing.
mhm,
Um, I'm still looking at the opportunities where they're more stabilized, but I'm also
mhm,
kind of looking at, okay, should I focus on some of these very distressed assets? And then
mhm,
also looking at same thing with there's a lot of different asset classes
mhm,
within commercial real estate, and there's opportunity in some of these other asset classes that might make a lot of sense. So
Hmm.
potentially
Yeah.
looking at different types of asset classes within the commercial real estate realm.
Yes, yes. I mean, end of the day, commercial real estate is commercial real estate. I mean, there's certainly multifamily had a really good run in the past 9 years just
Yeah.
because of the, more renters, the demographic shift in
Right.
divorce rate and student housing. I mean, student debt. A lot more people become renters. Baby boomers become renters. Rent has been growing really good, but the odds of it continuing is just not there.
Yeah. Yeah. So I want to know, like, what are you doing? You mentioned you're working on operations. What are the specific things you're trying to do right now to help? Like, what kind of things can you pass on to our listeners to help them understand? Okay, how can I improve my operations? How can I make sure my business is being operated successfully so that these properties do continue through
Hmm.
a downturn and through different ebbs and flows of the cycles?
Yeah, we're trying to look at all our expenses to see is there anything that we can cut. But that is very centric to expenses. On the income side, we're trying to see is there any miscellaneous income we can add in that without we putting in capital. But that's all income and expense, right? But just in terms of having a smooth operation, like everybody need to know what we are doing, right? On a very systematic way, right? So we're trying to implement this, standard systems and process. Like everybody need to know when you need to trigger an eviction process, right? So,
Mhm.
you know, rent is late on the 4th, and then we file eviction on the 10th, and what's the process to go until the eviction court, and when do we file rates? So we want everybody to know that, right? So things like that, what do we do make ready, how long does each make ready takes, how long a unit can be sitting idling after make ready. So we're trying to standardize all that process so that as you grow, I think you need that cookie cutter, McDonald's, Chick-fil-A systems into the apartment industry, right? Because otherwise it's a bit hard to grow.
Yeah, super important right now. I mean, especially you guys have 1,700 units. It's only going to get more complicated as you get more units. Once you have 3,400 units, it's going to be,
Mm-hmm.
you know, even more difficult if you don't have any of that stuff in place. So the
Correct.
bigger definitely the bigger you get, but even somebody who's sitting there listening to us and maybe has 10 units of single families and they want to get to 20 units. I mean,
Mm.
same thing. You've got to learn how to scale it. You've got to learn these systems and processes. You've got to be able to write that stuff down so everybody knows what they're doing. The eviction is like the most simple thing. I mean, I've got a property that's a out of state duplex. I've got a third party property manager, and I just you know this tenant is way behind on rent, and I wasn't keeping my eye on the ball, and they said, hey, when do you want to evict this tenant? And it's like, oh, what do you mean? Like,
You didn't ask me, right?
yeah, like this a process we should have in place already.
Yeah.
So it's just the simple things like that. Sometimes it's like, does everybody on your team understand what we all need to do to have success? And so I really like that you went
Yeah.
there. What's a mistake that you've made, and how have you learned from it?
Mistakes. Um, well, some mistakes, I'm not sure whether it's a mistake or not because we have not gone through a full, like looking at some deals where we could have done a lot more due diligence on it. I think
Ah,
that was one mistake.
yeah,
But sometimes you just do not know until you do not know what you do not know, right? So some of the issues. Um, we could have done better in due diligence. I mean, good thing we have cash to cover up our mistakes, but you know it could have been a much larger due diligence mistake, right, in some deals, right? So you want to be really do due diligence on a deal very thoroughly.
yeah, yeah, 100%. Yeah, it's so easy to make some mistakes, and if you're not being completely thorough, those can bite you. And you said you're
Hmm.
lucky because you had enough money, but man, what if you didn't?
Hmm.
Or what if they're just a little bit more expensive and it didn't cover? So,
Yeah, yeah.
um, What's a favorite business or real estate book you could pass on to our listeners?
Business book. I think The One Thing is a really good
Ooh,
book by
I
Gary
like that.
Keller.
Yeah, yeah, awesome book.
Um, yeah, The One Thing. Other business book. Well, I do not know about other business book. Oh, maybe this one. The Most Important Thing by Howard Marks. It talks about market cycle and how psychologically people, keep on buying without thinking,
Hmm.
and everybody thinks the cycle will never end. So it talks about market cycle and why does the market cycle happen and all that. So um,
Might be a great book for people to buy right now.
yes.
We talk about the market cycle.
Yeah, I'm reading that, and I can see whatever he says is happening right now, right? So people think there's no end in sight.
Yeah,
Multifamily will continue booming. There's so much lenders out there willing to give you capital. There's a lot of real estate investors who are feeling the fear of missing out. He mentioned exactly as what is happening right now,
yeah.
and I think he missed out one thing in his book because he's an older guy, so he may not know this. Right now is a lot more exaggerated by the social media,
Mm,
right? The FOMO effect, right? The fear of missing out effect is a lot more exaggerated by social media, which is,
yeah.
it can amplify the effect, right? Because right now you can see people closing deals, people are, so everybody else is feeling like, oh my God, I should have been involved in real estate and make money, right? So that one thing that he missed out in his book, but we can't blame him, right? Because he's not the current generation guy, um, but that's a really good book. The Most Important Thing. He has two books, The Most Important Thing and Mastering the Market Cycle. Both books are almost similar content.
It'll be interesting with that social media that you just mentioned.
Mm-hmm,
And as it continues to change and evolve and even get bigger,
mm-hmm,
when the market does finally shift,
mm-hmm.
does that social media play an influence on how long the next recession lasts? Will it last longer because of it, or will it last a shorter period of time because of it, or we'll just have no effect? I don't know, but it'll be really interesting to see how that plays into it.
Yeah, I do not know whether it can determine how long is the down cycle because we do not know exactly down cycle. But I think
Will it
it
make
would
it
have
deeper?
may make it deeper because there's a lot more people who has
A lot of
the
fear,
FOMO effect.
a lot of fear mongers out there throwing everything
Yes,
and
yes, correct,
making
correct.
everybody run for the hills.
Yeah, yeah. I mean, multifamily is still a really, really great asset, right?
Yeah,
But you have to buy it right,
yeah, yeah,
right?
and that's the
And
key.
yeah, that's the key. I mean, it's still a really good asset. It's a solid asset class. A lot of people need houses to stay, and we get really good financing from the Fannie and Freddie Mac and a lot of agencies. So all that, and it's a non-recourse loan. A lot of it, if you buy the agency loans, right, with the agency loans. So still a really good asset. But you have to buy it right, and that's where the problem is right now. A lot of people are just overpaying.
Yeah, I mean, look, it's commercial real estate. It's a cash flow game, and so many people
Hmm.
get caught up in the appreciation. I like appreciation as much as everybody else. I like forced appreciation the most, but
Hmm.
we all like appreciation, but it's still a cash flow game. So if you're buying
Hmm.
assets that just fundamentally don't make sense,
Hmm.
you're gonna get stuck. I mean, I just talked with somebody that was talking about all these people that are buying properties, and this was in like the single family, 1 to 4 family.
Mm.
But they're just buying properties that don't cash flow just to have some real estate, have their hands on real estate. And that makes no sense. And people that lived through 2008 crash and
Correct.
got burned by it,
Hmm.
everybody that I talked to, I'm sure you're the same.
Hmm.
Um, Everybody that got burned by it had, a lot of them had that same philosophy of, we're just buying real estate to
Mm.
buy real estate. We don't care
Hmm.
what the fundamentals look like. We're just buying it because real estate's, like
It's
gold.
cool.
It's cool. Yeah, everybody.
Yeah,
And all of a sudden something happens and catastrophic, and then people swear off real estate, and it's the worst thing ever.
it's the worst thing ever. Yeah, I still think it's definitely better investment than stocks and bond, because you
Yeah,
can't control the other two, right? This one
right,
you control. It's
right.
just that you have to buy it right.
Still have to buy it right.
Yeah,
So James, last kind of question before we wrap up. What are your
sure.
3 pillars of wealth creation?
Three pillars of value creation. Mindset is definitely a pillar. You have to have that mindset of that you can create wealth and you want to create, and you need to have that burning desire to create wealth. Second is persistence. You have to think differently from everybody else, right? If you're doing the same thing as what everybody else doing, you probably getting the same results as what everybody else, or you probably could never start because everybody is looking at the same thing, right? So you have to be persistent in finding different solution. Third is just hard work. You have to work hard. There's no shortcut to success. Don't think some guru out there is going to make you rich. Don't think market's going to make you rich. You have to work really, really hard.
Yeah, I agree. I mean, there's great mentors out there. There's great programs out there. There's great podcasts out there, books, whatever. But you still have to bust your butt.
Yeah.
It's not just nobody's going to hand it to you on a silver platter. You got to bust your butt.
Absolutely, absolutely. No two ways about it.
Awesome. Well, I love it. We could keep on talking, I'm sure, for a long time, but
Sure.
we got to wrap up. Thanks a lot for joining us on the show. Appreciate it. A lot of great information.
Absolutely, absolutely. And
oh, wait a second. Sorry, I totally messed up. How can our listeners get in touch with you? You got your own podcast.
Yes.
How can they reach that too?
So I have my own podcast called Achieve Wealth Through Value Add Real Estate Investing, where I interview a lot of operators. Todd was in the podcast. I think yours is going to come out soon. I also have a book for passive investors. A book is called Passive Investing in Commercial Real Estate: The Insider Secrets to Financial Independence, which is an Amazon. It's an audiobook, a physical book, and Kindle. So that is the only book out there that talks from passive investor perspective, right? On how can you invest or be more smarter passive investors, right? My Facebook group, Multifamily Investors Group, I'm very active there. I'm in LinkedIn as well. And these are the places where people can get in touch with me.
You have a website?
Oh yeah, my website is achieveinvestmentgroup.com. Achieve is like achieving a goal, and my email is james@achieveinvestmentgroup.com. ACHIEVE.
Awesome. Well, if you as a listener want to get a hold of James, check out his podcast. Great podcast. The book sounds fantastic. You know what? Even if you're an active investor and are thinking about getting passive investors, this sounds like a fantastic book because it helps arm you for the questions that they should be asking anyway. So I think no matter what, this sounds like a great book, and Facebook group. I'm a part of that too.
Yeah,
so,
absolutely.
Yeah. Awesome. Well, thanks, James.
Awesome.
Appreciate it. You have a fantastic rest of the day.
Thanks for having me, Todd.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.